Welcome to Skytech-Lens. In April 2025, the Trump administration shocked global markets by announcing a sweeping 39% tariff on most Swiss imports, targeting a $48 billion trade deficit. For months, industries were left in suspense, until July 31st, when U.S. Customs confirmed the tariff would include 1 kilogram and 1 ounce gold bars, the backbone of the COMEX standard. Gold prices on the COMEX soared to a record $3,534 per ounce as traders scrambled to assess the fallout. The tariff threatened to sever America's main supply of investment-grade gold, shaking the foundations of global finance and central bank reserves. Swiss President Karen Keller-Sutter rushed to Washington, but her pleas for reversal were ignored. The White House stood firm, citing the need to protect American interests. The failed diplomacy signaled a willingness to weaponize the financial system for America First goals, setting the stage for a high-stakes confrontation. Then, in a dramatic twist, President Trump abruptly announced on social media that the tariff would be scrapped, sending gold prices tumbling. The sudden reversal left investors and allies reeling, questioning the stability of U.S. trade policy. But this was only the beginning, a prelude to weeks of tense negotiation and shifting leverage. The world watched as the intricate dependencies between the U.S. and Switzerland were laid bare. The gold standoff had just begun. To grasp the impact of America's tariff, you must understand Switzerland's unique role in the gold market. Switzerland doesn't mine gold, it perfects it. 70% of the world's raw gold passes through its 4 major refineries, setting the global standard for purity and quality. No other nation matches the Swiss in throughput or reputation. Their refineries are a critical choke point in the global supply chain. Even the U.S. Federal Reserve relies on Swiss-stamped bars to back its currency. The tariff wasn't just a tax, it was a self-inflicted disruption to a strategic asset essential for America's own financial health. In Q1 2025 alone, Switzerland exported $36 billion in bullion to the U.S., nearly 2/3 of the trade surplus Trump aimed to erase. Ironically, the U.S. targeted the very product it needed most, risking chaos in a market built on trust and precision. Disrupting Swiss gold isn't as simple as finding a new supplier. It would mean rebuilding a global ecosystem of trust and logistics from scratch. The Swiss system's foundation of neutrality and discretion is irreplaceable. Global buyers trust Swiss refiners with vast quantities of high-value gold. The tariff threatened to unravel decades of stability in the gold market. Switzerland's fortress of gold remains indispensable. The world's financial confidence depends on it. The 39% tariff on Swiss gold sent bullion prices soaring and exposed deep vulnerabilities in the U.S. economy. Gold premiums spiked, raising costs for American buyers and threatening to push up bond yields, making U.S. exports less competitive. Analysts warned the Federal Reserve might need to inject up to $75 billion to stabilize markets, undermining the administration's fiscal goals. The policy created a circular problem, trying to fix a trade deficit by destabilizing financial markets. Politically, the tariff split the country. Mining states like Utah cheered, hoping for a boost to domestic gold, while jewelers and manufacturers in states like New Jersey and Illinois sounded the alarm. For them, a 39% price hike threatened jobs and business survival, sparking furious lobbying for exemptions. The tariff, meant as a blow to Switzerland, ignited a multi-front war at home. It revealed the complexity and risk of weaponizing trade policy. America's internal divisions were now as exposed as its economic vulnerabilities. Switzerland didn't back down. Instead, it launched a diplomatic counteroffensive, quietly reminding the U.S. of its critical role in pharmaceuticals, luxury goods, and precision instruments. Swiss officials made it clear, trade is a two-way street, and a trade war would hurt both sides. Their leverage wasn't military might, but near monopolies in indispensable sectors. The Swiss drew a red line on banking secrecy, refusing U.S. demands for access to financial data, a principle rooted in national identity. While tariffs on goods were negotiable, financial privacy was not. This forced the U.S. to recognize the limits of its pressure. Switzerland's steadfastness protected its brand and shifted talks back to practical trade issues. The standoff became a lesson in national leverage and mutual dependence. Negotiations moved toward compromise, but the Swiss would not yield on their core values. As autumn arrived, Switzerland changed tactics, opting for a more personal approach. On November 4th, Swiss business leaders, including the CEOs of Rolex and MKS PAMP, met President Trump in Washington. Their Golden Charm offensive featured a custom gold Rolex desk clock and an engraved 1 kilogram gold bar, gifts symbolizing Swiss precision and value. The gesture was calculated to appeal to Trump's appreciation for luxury and spectacle. The meeting marked a turning point. The tone of negotiations shifted, and the Swiss pitched a vision of partnership and investment, not just relief. Critics in Europe decried the move as gold bar diplomacy, but Swiss leaders saw pragmatism as essential to saving their industry. The stakes were too high for idealism. The charm offensive worked. Washington was now open to a deal. The Swiss gambit was about to pay off. 10 days after the Golden Charm offensive, a breakthrough was announced. The US slashed the gold tariff from 39% to 15%, providing immediate relief to Swiss refiners and calming global markets. In return, Switzerland pledged a massive $200 billion investment in the US by 2028, with $66.7 billion front-loaded for 2026. The investment targeted pharmaceuticals, advanced manufacturing, and even gold refining, plus a new Pilatus aircraft plant in Utah, appeasing pro-tariff states. President Trump claimed victory, touting jobs and investment as proof of his tough negotiating. Switzerland preserved its gold industry and banking secrecy, transforming a trade war into a strategic partnership. But the deal faced hurdles. Swiss parliament and a likely public referendum would have the final say. The compromise was fragile, its fate resting with Swiss voters. The gold bar diplomacy that worked in Washington would now be tested at home. The world watched as Switzerland weighed the costs and benefits of peace. The November deal averted disaster, but the fallout lingers. Many in Europe and Switzerland saw the gold bar diplomacy as a troubling sign of transactional politics. Critics argued that elite interests had bypassed traditional diplomacy, raising questions about the integrity of statecraft. The White House insisted the $200 billion investment, not the gifts, drove the deal, but skepticism remained. Economically, the gold market has not returned to normal. A lasting premium of $2–3 per ounce persists, reflecting new costs and risks. This scar is a permanent tax on the global financial system, a reminder of the fragility of supply chains. Even resolved, trade wars leave behind friction and costs for businesses and consumers. The Swiss gold standoff proved that the threat of tariffs can be as disruptive as their implementation. The price of peace is a small, permanent surcharge on the world's most trusted asset. The US-Switzerland gold dispute of 2025 is more than a market panic. It's a case study in modern trade and diplomacy. Switzerland's near monopoly on gold refining showed that small nations can wield outsized power if they control a critical choke point. The episode suggests that dominance in niche sectors, like semiconductors or rare earths, can rival traditional economic or military might. The US learned that protectionism has limits when strategic imports are at stake. Compromise is sometimes the only option. The Golden Charm offensive set a precedent. Grand gestures and personal diplomacy can trump traditional negotiations. This could encourage more transactional, unpredictable global relations. The saga revealed America's deep reliance on a small, neutral nation for financial stability. The $48 billion deficit was just the surface. Beneath it lay a web of mutual dependence. The dispute forced a rethinking of how we value trade relationships, beyond simple deficits and surpluses. In the machinery of global commerce, every cog, no matter how small, can be critical. Thanks for watching. Subscribe the channel for more updates.